Over 3,000 kilometers separate the trading floors of Mumbai from the airspace of the Levant. But when the night sky lights up with missile trails over the Middle East, Dalal Street immediately feels the blast radius. In a single trading session, 12.39 lakh crore rupees were wiped out of the Indian equities market. Investors scrambled for safety, triggering a massive sell-off that dragged the Indian rupee down to a historic low of 93.71 against the US dollar. That marked the sharpest single-day decline for the currency in 4 years. India is frequently celebrated as a fast-growing Goldilocks economy, where growth is strong but inflation is manageable. Yet this sudden market panic exposes a deeply rooted vulnerability. The Indian economy is permanently tethered to the Middle East. How does a geopolitical conflict on the other side of the Arabian Sea systematically drain the wallet of an average Indian consumer? It happens through a precise sequence of events. First, regional tensions threaten energy choke points. That panic spikes oil prices, which widens the trade deficit and crushes the currency. Finally, that devalued currency imports higher costs directly into domestic supply chains. When global shipping lanes and oil supplies face severe disruption, the resulting financial damage is a mathematical certainty. This map illustrates the scale of the vulnerability. India imports roughly 85 to 90% of its crude oil and 54% of its liquefied natural gas. A massive portion of that energy flows directly out of the Persian Gulf and through the Strait of Hormuz, a 33-kilometer maritime choke point before hitting India's coast. The moment conflict threatens that strait, Brent crude prices surge toward $110 a barrel. The macroeconomic math is unforgiving. Every $10 increase in crude oil shaves 15 basis points off India's GDP and rapidly widens the current account deficit. The current account deficit is a metric that measures the total net flow of money in and out of a country, meaning India is spending far more on foreign trade than it is earning. Because of this heavy structural reliance, India effectively pays a direct tax on every barrel of oil whenever Middle Eastern tensions flare. That extra cost extends immediately to maritime logistics. With the Red Sea and the Strait of Hormuz compromised, Indian shipping vessels are forced to reroute. This adds days to transit times and pushes freight rates up by 10 to 15%, helping drive India's trade deficit to a staggering $27.1 billion. The conflict also stalls long-term strategic projects. This map details the international north-south transport corridor. The route connects Mumbai to the Chabahar port in Iran, designed to bypass Pakistan and link India directly to Central Asia. Ongoing hostilities have severely delayed the port's expansion. The Gulf region's influence extends to agriculture, as it provides the essential natural gas required to manufacture urea. Urea is a high-nitrogen chemical compound used as a primary agricultural fertilizer. With natural gas supplies threatened, the cost of securing these imported urea fertilizer bags is expected to skyrocket. This puts India's 1.71 lakh crore rupee fertilizer subsidy bill under immense pressure just before the critical planting season. A single regional conflict manages to simultaneously choke India's future export ambitions and threaten the foundation of its domestic food security. Securing expensive oil and fertilizer requires a massive outflow of US dollars. At the same time, spooked foreign institutional investors have pulled roughly $8.5 billion out of Indian equities, accelerating the drain on foreign exchange reserves. Then there is the human capital risk. There are nearly 10 million Indian citizens working in the Gulf region, placing a massive expatriate workforce directly inside a volatile zone. Those workers send home roughly $50 billion annually. These remittances play a major role in shoring up India's finances, but a prolonged war threatens to severely reduce that critical financial inflow. The war attacks India's balance sheet from both sides at once. It maximizes dollar outflows for expensive imports, while directly threatening the dollar inflows from foreign investors and migrant workers. Back on Dalal Street, the macroeconomic data translates into clear winners and losers. Sectors highly sensitive to petroleum costs, like aviation, chemicals, and oil marketing companies, are taking massive financial hits as their operating margins shrink. This chart compares those struggling industries with the beneficiaries of the conflict. While aviation and chemicals trend downward in red, the green upward lines show a surge in investment for defense contractors, oil exploration companies, and gold-related assets as capital flees toward safe havens. The effects extend far beyond stock portfolios. This dynamic creates imported inflation, a scenario where a weaker currency makes all foreign goods more expensive. The government has already had to invoke emergency powers, directing refiners to maximize domestic production of LPG gas cylinders to prevent cooking fuel shortages. Whether it takes the form of polymer supply shortages hurting local plastic manufacturing or costlier cooking gas in the kitchen, average citizens ultimately foot the heavy bill for a foreign war. This forces the Reserve Bank of India into a tight corner. The central bank must choose between raising interest rates to combat this imported inflation and keeping rates low enough to protect India's overall economic growth. To survive the immediate shock, the government has to execute rapid strategic pivots. This involves expanding domestic strategic petroleum reserves and scrambling to secure alternative maritime trade routes. However, those measures are just temporary buffers. The true long-term solution is aggressive diversification into renewable energy, physically breaking the fossil fuel tether that binds the economy to the Middle East. The Iran-Israel conflict is a profound economic stress test. Until India achieves true energy independence, its economic destiny will remain perpetually hostage to the volatility of the Middle East.